Good Monday. This is Jay Brew, co-chairman of Seafried and Brew. Well, coming out of the Memorial Day weekend is that we not only had the Treasury go above the 2% level, but in this morning we're at 2.1%, 2.10 on the 10-year. Is this a worry? Well, we've had some good economic news pop out in here today. For instance, consumer confidence, highest since 2006. Along with that, housing prices continuing to move up. Good news, bothering the markets because suddenly the thought is that will the Fed stop buying treasuries and mortgage-backed securities? Earlier in the year, we were also tested by this with the 10-year Treasury rising up over that 2% level. A lot of bankers scared that it was going to just continue to move up and move up. Actually, bankers hoping that interest rates would continue to move up and up. But we had to look at what we need to know as community bankers not to get involved in all of this noise that's happening. We really have to look at it based upon what is the economy going to do. And that's why we've stressed over and over again, we want to be looking at indexes that show us the overall direction of the economy away from what we hear from the talking heads on a day-by-day basis. So it just so happens we had released the 6-month Fed Philadelphia forecast. Now this is March, last month's forecast, and if you remember as we talked about this, that essentially this was suggesting going forward over the next 6 months a 1.6% GDP. So when we look at that on an overall basis, will that bring unemployment down? The answer would be no, that this is still very slow to moderate growth. We might see some improvement in unemployment, but not to where the Fed has set its goal at 6.5%. So when we think about the next forecast, which just came out, is that you look, it's similar to the previous one. Certainly we've had some improvements in the huge economies like Texas and Illinois, but we have to look at the country on an overall basis. Interestingly enough, it actually moved down to a growth rate of 1.4%. So as we look at this, does that suggest that unemployment is going to move down? Our answer on that would be no. And we want to be looking at this as an overall buying opportunity in here. Last week I talked about growing with, say, looking at 15-year mortgage backs. Interesting enough, the prices have dropped on 2% coupons, that you're looking at discounted prices which we haven't seen for some time. So this could be a real buying opportunity both in the area of the 15-year mortgage backs, which we've been talking about, as well as looking at any kind of cheapening up in the taxable municipal market or tax-exempt municipal market. So we'll have to see how this progresses, but once again, we want to go based upon what we know, and what we know is saying in the next 6 months the economy grows at about a 1.4% rate, which would be slow to moderate. So we can move away from the noise and we can look at this on an overall basis of interest rates still remaining in this trading range that we've been in. This is Jay Brew, co-chairman of Seafried and Brew. Have a great week.